Hello good people, this is me, your money manager Kumo Itzile Kosi Itzile. In today's video, I want to do two things. First, I'm going to update you on my Pula cost averaging journey. The journey has begun and it's just exciting. So I'm going to share with you the successes that we've made in the month of March, because March is just ending. And then secondly, I'm going to help you to analyze a company so you can choose the right company to invest in. I'm just going to share with you some financial ratios that you have to look at to pick a company to invest in. This is for somebody who is saying that, you know what, I want to be an individual stock picker and I don't know where to begin. So this video is meant to guide you to do the fundamental analysis of the company so you can select the right company to invest in. First things first, let me update you on my Pula cost averaging journey. I must admit, this journey is getting me overly excited, and it also makes me question myself to say, why didn't you start this earlier? But hey, then it doesn't mean like I haven't been doing anything. I have been making bad financial decisions, and also good, because this is why we have this video. If I didn't go through all those bad financial decisions that I made in my life, I wouldn't be where I am today. So I'm also embracing that fact. Yes. So what have we done? What have we been successful with in the month of March? I'm going to tell you that, you know what, we were able to send our 3,000 money, and that money bought us shares in 3 different companies. So this is what happened. Last month, we were able to buy StanChart. 1,000 got us 175 shares at $5.40. This was in February. In March, the same 1,000 got us 173 shares at $5.48. Notice here the number of shares reduced slightly, just 2. This is because price has changed. We now bought at a higher price than we bought at in the month of February, and this is what Pula cost averaging is all about. So let's move to another company, Absa. In the month of January, 1,000 got us 148 shares at a price of $6.38. This month, the same 1,000 got us 147 shares at a price of $6.45. You would notice that there was an increase in price. This is why we got 140 shares compared to 148 in the month of January. Just a slight difference as well. We were also able to get FNB. I'm not going to compare FNB with anything because FNB we just started this month. Our 1,000 got us 207 shares at a price of $4.57. So we'll be able to see a comparison in the month of April when we send another 1,000 to get us FNB. So this is my Pula cost averaging journey in motion. Now we're done with that one. Now let's move into the serious stuff of today's video. Analyzing company financials, the key ratios that you look at. I'm going to share with you 5 categories of ratios that you need to look at as an investor. 1 is valuation ratios, 2 is profitability ratios, 3 is liquidity ratios, 4 is debt or solvency ratios, and lastly we're going to look at efficiency ratios. These ratios are meant to help you select the right company. You have to know how they are calculated, and you have to be able to know how to interpret them to make financial decisions. So let's start with the valuation ratios. With valuation ratios, what we are doing is we are seeking to understand the intrinsic value of the company. The intrinsic value of the company, we are referring to the true value of the company. What is this company worth? That is what we are seeking to understand. We do this because we want to ensure that when we buy, we are not buying an overly priced company, but rather we are buying an undervalued company. Because if you're buying an undervalued company, then there's a probability that that company over time will grow in value, and that is how you are going to make your money. So let's start with the first ratio. The first valuation ratio that we look at is price earning ratio. What is price earning ratio, or what does it do? The price earning ratio is going to compare the share price to its earnings per share. So here we're basically looking at how expensive is this share price relative to its earning. How is this ratio calculated? It's calculated by looking at the current share price divided by the earnings per share. And what is a good ratio? 15 or lower is better. You're looking at a lower number. Let's say the price earning of a company is 15. So what you're basically saying is that for every 1 pula that you are earning per share, you are paying 15 times to get that. So you can realize that a lower number is always the best number. The second valuation ratio that we look at is price to book ratio. Price to book ratio, here we are comparing the share price of the company to its equity. If the company were to be sold today, where will we sell it at? And how do we calculate price to book ratio? We look at the current price per share divided by the book value per share. Somebody would ask, how do I get the book value per share? Book value per share, you are going to look at the company's total assets minus the company's total liabilities. You divide that by total outstanding shares. You are going to get the book value per share. That is the formula for calculating the price to book value. So then how do I go about selecting? How do I know which ratio is better? A healthy ratio is 3 or lower. You're looking for a lower number. These are your valuation ratios. Now let's move to profitability ratios. Let's cover 2 ratios that will show us how profitable a company is. The first ratio that we look at is return on assets. With return on assets, we are basically answering the question, how efficient is the company in utilizing its assets to generate earnings? So what is the formula for this? It's net income divided by total assets. A healthy ratio is 5 or higher. The higher the number, the better. The second profitability ratio that we look at is return on equity. I'm sure we always see this one, like in financial statements. Mostly these numbers are calculated for you, but you just need to know what they mean. So return on equity. Return on equity, we are saying how efficient is the company's management in utilizing shareholders' money to generate earnings. So how do we calculate this ratio? We say net income divided by the company's total equity. That's how you get the number. Healthy ratio, a high number is always better, but this is subjective. This is industry subjective, so you have to make sure that you're comparing apples to apples. So looking at industry per industry peers. Peer analysis is very important here. Let's look at liquidity ratios. We are measuring the company's ability to cover its short-term obligations, anything that needs to be paid within 12 months from its current assets. 2 ratios that we look at current ratio. Current ratio, we are saying the current assets, are they able to cover the current liabilities? So the formula is current assets over current liabilities. And the higher the number, the better. But a healthy number is 1.2 to 2. But also this is industry specific, so you have to make sure that you're doing that peer analysis. The second ratio that we'll look at is quick ratio. So here we are saying how quick, or what is the company's ability to cover its current assets without necessarily having to sell its inventory. You know that inventory, sometimes it will take a longer period of time to sell. So we're excluding that and we're looking at all the other current assets. So the formula for this is current assets minus inventory divided by our total liabilities. That is the number. So a healthy ratio is 1. A ratio of 1 is always better, but a higher number is even better. So, but this is also very industry specific. You also need to make sure that you're looking at peer analysis. Those are your liquidity ratios. Let's move to our solvency ratios. Here we are measuring the company's financial gearing. We are looking at the company's operations, and the question that we want to answer is, what extent of debt has been used to finance the company's operations versus using the company's own money. Shareholders' equity, that's the company's own money. So we're comparing that. And ideally, there has to be a balance. If the company is excessively using debt to finance its operations, we say that that company is over leveraged or over geared, and that could be a red flag. How do we calculate this ratio? We say company's total liabilities divided by total shareholder value. The ideal or a healthy ratio is 1 or 100%. If it's more than 100%, the company is overly geared. There is more debt than the company's shareholders' equity, and I've said that could be a red flag. Last ratios that we look at, these are efficiency ratios. The one ratio that we look at is asset turnover. With asset turnover, we are measuring the company's ability to use its assets to generate sales or revenue. That we call asset turnover. We want the company to optimally utilize its assets to generate sales or revenue. So how do you calculate this ratio? We are going to look at the company's total sales. Total sales, this is the top line. I'm sure you've heard people analyzing financials and accountants that will say the company's top line, there's the company's bottom line. Top line, this is the sales or revenue. Company's bottom line is the net profit. So just know that net profit or net loss. So how do we calculate the asset turnover? We say the company's total sales divided by the company's average assets. How do we find the average assets? We are going to look at assets at the beginning of the year plus assets at the end of the year. We divide that by 2 to find our average assets. Healthy ratio, a higher number, is always preferable. Somebody would be asking, where do I get all these numbers? Where do they come from? These numbers, you get them from the company's financial statements. This is why, as an investor, if you are choosing to go the individual stock picking route, then you just have to make reading company financial statements a habit. It has to be part of who you are. Start reading them, learn how to read them, and learn where to get the information. Mostly for all the listed companies, if you go into their websites, you are going to realize there would be a tab for investor relations. Under investor relations, that's where you are going to get the company's financial statements, and you have to open them and read them. Company financial statements basically look at 3 statements. The first statement that we look at is profit and loss statement, which is going to show us our sales, revenue, and then it's going to show us our expenses, and it'll show us the bottom line, which I've said is the net profit or the net loss. The second statement that you're going to look at is your balance sheet. Your balance sheet is going to show you your assets, your liabilities, as well as your company's shareholders value or equity. And then lastly, we are going to look at the cash flow statement, company's cash flow statement, which shows the inflows, the company's inflows and the company's cash outflow, which are coming from operating activities, financing activities, and investing activities. It is very important to start learning how to read company financial statements if you want to be a successful investor. It's just because you need to know the fundamentals. You need to learn how to analyze financial statements. This is not exhaustive. Obviously, there are other things that you have to take into consideration when you choose an individual company to invest in, but I just wanted to share with you how to analyze the company's financial statements and the key ratios that you have to look at to pick a company to invest in. This is all that I wanted to share with you today. I hope you found this video insightful. Please don't forget to leave a comment and a like for me. Thank you so much for your time. I will see you in another video.